Donald Trump has just announced large reciprocal tariffs and the stock market is tanking. So right now is probably a good time to solidify your stop loss strategy so that this move doesn't blow your account. So in today's video, we are going to be talking stop losses, but I'm not just gonna give you stop loss ideas or make up general theories. We are actually going to look at how I utilize stop losses in some of my own strategies and the statistics behind why I use those stop losses. So moving forward from this video, you will have exact, statistically proven, objectified, good ideas for where you should be placing your stop losses in your trades. Quick story time. A member of my website, daytradingstrategies.net, reached out to me and asked me if I could build these ATR labels. This is something that he learned from another trader, but in a different platform rather than Thinkorswim. And one of the perks you get for being signed up to my site is I will build stuff for you if I have the capability to do so. And of course, I'm the best, so I was able to build these ATR labels. In fact, if I come in DTS ATR, these risk labels, this is what I built for him in Thinkorswim. I want to quickly talk over what these labels are doing and why the average true range indicator is a great tool to objectify our stop losses. And since I've already brought it up, if you are interested in accessing over 140 plus custom codes within Thinkorswim, as well as having that access to reach out to me to have me build stuff for you, all of that is available for you over on my website, daytradingstrategies.net. Click sign up. You pay one low price. You get access to everything. I also have a course available if you would like to learn how to code in Thinkorswim yourself. Check that out as well. Anyway, link to the website in the description below this video. The average true range indicators formula is relatively complex, and I'm not that good at math. That's why I got my degree in computer science, so I can make computers do it for me. But basically, in layman's terms, what the average true range indicator is measuring is the average distance from high to low over the last X number of candles back, and the default length, as you can see in this parameter here, is 14. So basically, the average distance, once again, that each candle has traveled in price over the last 14 candles is what is being spit out by the ATR equation. And as I'm sure you can tell from looking at the ATR study running on our chart here, as the ticker gets more volatile, of course, the ATR value goes up. And when the ticker is less volatile, so it's trading in a tighter range, the ATR value goes down. This is extremely powerful to utilize as an objective value for stop loss because it builds in that volatility automatically. If you are trading a more volatile ticker, it's typically a good idea to give it more room to breathe. The move down it's making might just be part of the natural volatility of the ticker, and you don't want to get stopped out on a really small basic drawdown before the move up, right? In stock trading, you are almost never, I shouldn't say almost never, but it's very rare that you're going to buy a ticker and it's just going to go straight up. You're oftentimes going to buy, it's going to come down. You have to hold through a little bit of pain before you get that move up. Beginners always tend to struggle, though, with that concept of how much pain should I hold through. They either hold way too long or not long enough, giving the ticker the room to breathe that it needs, and using the ATR value in this way helps you to balance both of those out, right? Because once again, if the ticker is more volatile and you are using a entry price minus ATR stop loss, then you know, hey, if this thing drops, even if it drops, the ATR value here was 9 points. So even if it drops 5 points, I'm going to keep holding this thing. The ATR is really high right now. It's just really volatile. I'll give it its 9 points down to breathe. Whereas here, the ATR value is only 5.2. So hey, if it drops 5 points, I'm going to go ahead and get stopped out of this move because it's less volatile. I don't need to give it as much room to breathe. Does that make sense? So now looking at the labels here in the top right that I built for the member of the site, we have the current price of the ticker. We have the current ATR value, and he actually requested specifically that we look at the ATR value with the length of 10 rather than a length of 14. That's just his personal preference. Of course, I always want you to take the codes that you import from my website. You will get access to all the source code. So feel free to come in and mess with and adjust and find what works best for you. But anyway, if I change the ATR to 10, you can see now that the current ATR value is 11.4 as shown in the label. The ATR times 2, of course, being 22.8. That is what this user, the member of daytradingstrategies.net, wanted to set up as his stop loss value. So if he's taking a position size of $25,000, which is an input on this study, you can easily change that from the inputs of the settings of the study, as well as your percent risk. You can adjust that. Position size of 25,000, the number of shares that he should buy to get stopped out at a 22.8 point drawdown from here in order to risk 2% of that position size is 22 shares. So 22 times 23, let's call it. What is that even? Let's look at the calculator real quick. Let's do 22 times 22.8. If he were to get stopped out of this trade, he would lose $501.60. Of course, 2% of 25,000 being $500. That looks to be exactly right. So it's sort of building out based on his position size and percent risk amount, how many shares he should be buying based off of a 2x ATR stop. It gives you the price at which he will stop out. So basically just current price minus the ATR times 2 being 519.8. And what he was looking for here was a 3-to-1 risk reward ratio. So it also shows you what his profit target would be based on that. If he's getting stopped out at 519.8 right around here, drew it a little bit too low, but you get the idea. His profit target will be 611.20, pretty much a double top on SPY if you were to buy here and utilize these metrics. So that gives you an idea not only of what these labels are doing, but of a strategy that this particular user is looking to implement utilizing ATR as a stop loss. Let's go ahead now and take a look at some of the strategies that I run that also incorporate an ATR stop loss, because I do utilize this study in some of my own strategies as well. So currently running on the chart behind me is my large cap runner strategy. This is a continuation strategy that buys strength and then only gets stopped out when weakness appears. You will notice there are two lines plotted on this chart, being this cyan colored line and this pink salmon-ish colored line once I'm in a position. Both of these are my stop loss exits for this strategy, and they both revolve around using the average true range indicator. I'll actually click into the source code of this strategy so that you can get a peek behind the curtains of what I'm talking about. This plot S here will be the cyan colored line. That takes the closing value of the previous bar minus the ATR value out of the previous bar times 2.5. So that is what this cyan line is always tracking. The value that the previous bar closed at minus the ATR value of that candle as well, multiplied by 2.5. Whereas the T plot here will be this salmon colored line that only appears once we are in a trade because it uses the entry price variable. So the price at which I bought the ticker at, according to the strategy, minus the ATR value of the previous candle times 1.5. So if we come back out here, we'll see I entered this trade at about $350 a share, and the ATR value at the candle before I got stopped out is 5.3. 5.3 times 1.5 is probably something like 8, if my quick math is okay there. And we can see that our difference between the line at which we bought and the salmon colored line is 8.5 points. So right around 8, right around that value. That is where we get stopped out for a loss on this strategy. If you get into continuation and it fails like this, you get stopped out at the close of the candle that closes below it instead of eating the rest of this loss. And here is a trade case in which we get stopped out when the cyan colored line is touched. This is more of a harsh downturn, kind of quick volatility change catch to get out of the trade before it falls much harder, right? So once again, the close of the previous candle is exactly 319 and the ATR value is 5.7. What is 5.7 times 2.5? I don't know exactly. What's it, like 13, but a little bit less than 13, I would assume. Well, no, 2.5. It'll be a little over 13. We can actually see here, if I draw from this close down, it is about, let me see, this bar down. It is right about 13 points. Yeah, seems to be the stop loss. And on this candle, when it touches that line, so rather than the stop loss of this salmon colored line, when it needs to close below it, this one, it just needs to touch, then the strategy will exit at that price, at the price in which those two values overlap. So those are two different ways that I utilize the ATR in one of my own continuation trading strategies, both for a, stop loss based on the entry price and a volatility check to quickly get out of a trade if it downturns very quickly. The average true range indicator is, of course, just one example of a study that you can utilize to objectify stop loss areas. Here is another separate strategy that I have now turned on that uses a completely different indicator, that being the 200 length simple moving average, which you see plotted on the chart as this cyan line here. If you don't know what a simple moving average does, it is measuring the average closing price over the last 200 candles. Now, all this strategy is doing, this is a basic investing strategy that focuses on protecting large drawdowns. This strategy simply buys above the 200 simple moving average, sells below the 200 simple moving average. The buy and hold strategy, like the Warren Buffett strategy, is extremely powerful and has always been extremely powerful because, for the most part, the S&P 500 has always gone up. Like, we just re-entered correction territory as of today, as of filming this video, because we are down more than 10% from all-time highs. But even that is like really a blip on the radar when you scroll out and really look at the long-term picture of the S&P 500. But it doesn't mean it will always go up, right? The buy and hold strategy is still a strategy that is essentially always being back tested because there's never like a sell. And right now it just works really, really well because the market's always gone up. But look, I mean, this is 2008. This is the housing crisis of 2008. From market high to market low, the market drops over 56%. And if you're using this strategy, your profit drops from, you're up $11,000 to all the way at this bottom, you are still up $10,700. You don't lose much money at all. You're just sitting in cash during all this weakness. Then you begin re-entering when strength begins to appear here. So you're protecting that downside. Like, even in a buy and hold strategy, once again, just because it works really, really well right now, a strategy like this and utilizing the 200 simple moving average in this way can protect you from what we don't know is going to happen in the future. None of us knows where this market is going to go 5, 10, 15, 20 years from now. And using a strategy like this, while it may be underperforming the buy and hold right now, doesn't mean it always will be, and is a great way to help protect your capital if that's something you're worried about. There's a lot of people out there that just straight up don't invest their money. They just leave it in a savings account, leave it in their checkings account because they're afraid of the downside risk of the market, which will always be prevalent. And this is just a simple yet effective way that you can help cope with that. You can get around that a little bit. You will know sort of, hey, the market is really weak. I mean, once again, we go look at 2022. During the 2022 bear market, it drops, just as another example, down over 27%. And you go from being up 22.6 to at this bottom still being up $20,700. It's just a great way to protect your investment capital. Once again, utilizing the 200 simple moving average as an objective stop loss tool. Just remember any of the strategies you've seen in today's video, the ATR position size labels and the back test labels, which are extremely powerful, probably my most popular and requested code. They're all available for easy import alongside over 140 plus other custom coded strategies, studies, scanners. You can even copy my exact workspaces, etc., etc. And every single code comes with one of these TOS share links. Thinkorswim is really, really good for accepting and easily importing codes. All you need to do is copy this link down back within your Thinkorswim, set up in the top right, open shared item, paste in the link, preview, and import. And whether you imported a study strategy or scanner, you turn it on just the same way you would any other code of that type. So I just imported DTS Bollinger Break. You can see it is there available in my edit studies modal. Double click to put it on the chart. And just like that, in about 10 seconds and 4 mouse clicks, you can have any of the, once again, 140 plus codes from the website stored locally within your own Thinkorswim. There's also the course, which consists of 10 chapters and 36 sections. Every single section comes with a video lesson by me, as well as a text lesson, and this course will take you all the way from knowing really nothing about Thinkorswim or coding at all the way up to being able to code exactly like I do now. You will learn how to code any custom study strategy, scanner, conditional order, automated alerts, etc., by the end of this course. Once again, the website linked in the description down below. If you would like to access the 140 plus codes, click on the green sign up button. You'll get access to all 140 plus for just $35 a month. It's something like less than 20 cents a code or some ridiculous value like that. And I do have it set up as a monthly subscription, as I am always adding and updating new codes on the website. But if you would like to cancel your subscription, you can do so at any time with just 3 mouse clicks under the My Account tab. And if you would like to sign up for the course, click on the course link on the website. It does cost $350. And I know, Trey, $350, what the hell? But think about all the times you've lost hundreds of dollars trading like a jackass in the stock market, and maybe invest that into yourself and learn how to trade statistically rather than randomly throwing money into the stock market. If any of that is interesting to you, links in the description down below. Once again, go check it out, at least read the reviews, help decide if it's something that could help accelerate your trading journey. Anyway, all the ad reading out of the way, please hit the like button if you learned something in this video. Make sure you subscribe to the YouTube channel by hitting the red button down below if you would like to continue learning. And with all that being said, I'm going to go ahead and sign out of this video, and I'll catch you all in the next one.